Hey there! Let's talk about something that weighs on millions of people: credit card debt. I get it. Just seeing that stack of bills or thinking about the total can make your stomach drop. You already know it's bad. The ads call it flexibility, but you feel its toxicity every month when the payment is due and your balance barely budges. But let's move past the guilt and the stress. Today, it's not about shame, it's about strategy. We're going to break down 5 real paths out of this in plain language. No judgment, just options. First, let's look at the monster in the room: the numbers. Why does it feel so impossible? It's the interest. The average U.S. household carries about $8,000 in credit card debt. The average interest rate right now is hovering near a brutal 23%. If you only make the minimum payment, typically around $140 on that amount, grab a seat. A standard calculator, like the one on Bankruptcy, shows it would take you over 4.5 years to pay it off. And the real kicker, you'd end up paying nearly $5,000 in interest alone. You'd pay more in interest than you would for a nice vacation, a new appliance, or a solid start to an emergency fund. That's money literally vanishing, buying you nothing but stress. That's the do-nothing scenario, but you're here, so you're done with that. Let's explore your 5 main battle plans. 1. The balance transfer. Playing the introductory rate game. What it is: you apply for a new credit card that offers a super low, sometimes even 0% interest rate for an introductory period, usually 6 to 21 months, and transfer your existing balance to it. The human pros. Breathe. This is the biggest one. Slashing your interest rate to 0% means 100% of your payment goes to slaughtering the actual debt. You can finally see progress, momentum. Watching that principal drop fast is incredibly motivating. It turns a slog into a sprint for a little while. The human cons and fine print. The fee: they almost always charge a balance transfer fee, usually 3 to 5% of the amount you move. Transfer $8,000, that's a $240 for $100 upfront cost. Factor this in: the cliff, that 0% rate is temporary. You must have a ruthless plan to pay it off before the promotional period ends. If you don't, the rate often jumps to something even higher than your old card: the credit hurdle. You generally need good to excellent credit, a score often above 690, to qualify for the best offers. My take: this is a fantastic tool if you are disciplined. It's like a financial pause button on interest. But you have to attack the debt during this pause. Set a monthly payment goal based on the deadline. Put the new card in a drawer. Do not use it for new purchases. 2. The debt consolidation loan. The simplifier. What it is: a personal loan from a bank, credit union, or online lender like Upstart or Discover that you use to pay off all your cards. You swap multiple high-interest payments for one fixed monthly payment. The human pros. One and done. The mental relief of having one payment, one due date, and one interest rate is profound. It declutters your financial life. A clear end date. These loans have fixed terms, for example, 3 or 5 years. You can mark the finish line on your calendar. There's light at the end of the tunnel. Potentially lower rate. Even with average credit, you might secure a 15% loan, which is better than 23%. The human cons and fine print. It's still debt. You haven't erased debt, you've moved it. If you don't cut up the old credit cards, it's terrifyingly easy to run them up again and be in twice the hole. Rates vary wildly. Your rate depends heavily on your credit score. With poor credit, you might not get a better rate at all. Hard inquiry. Applying will cause a small, temporary dip in your credit score. My take: this is for the person who needs structure and hates juggling multiple bills. The key to success is behavior change. Lock or destroy the old cards. The loan is a tool for organization, but your budget is the real solution. 3. Tapping home equity. Helic, the high-stakes option. What it is: a home equity line of credit. You borrow against the equity, the portion you own, in your house. The human pros: very low rates, because your home secures the loan. Rates are often dramatically lower than credit cards, closer to mortgage rates. Large sums: you can potentially access enough to wipe out all debt in one go. The human cons and fine print. Read this carefully. You are risking your home. This is not an exaggeration. If you fail to repay, the lender can foreclose. You are trading unsecured credit card debt for debt secured by your roof. Variable rates. Many HELOCs have rates that can rise over time. It enables avoidance. It doesn't solve a spending problem. It just moves the problem onto your most valuable asset. My take: I am very cautious here. This can be a responsible tool for someone with sudden, high medical debt who has stellar financial discipline. For general credit card overspending, it can be like using a fire hose to put out a candle and flooding your house in the process. Tread very, very carefully. 4. The retirement account raid. The last resort temptation with it is pulling money from your 401k, IRA, or other retirement account. The mechanics: withdrawal. If you're under 59 and a half, you'll pay a 10% penalty plus income taxes on the amount. A $10,000 withdrawal could net you only about $6,500 after penalties and taxes. You've just torched $3,500 of your future. 401k loan. You borrow from yourself and pay back with interest into your own account. No tax penalty if you follow the rules. The human pros, the siren song. It's your money. It feels accessible. The process can be quick. The human cons, the reality. You are stealing from future you. That money loses all chance for compound growth. A $10,000 withdrawal today could be $70,000 less in retirement. You are solving a present problem by creating a massive future crisis. The job trap. If you leave your job voluntarily or not, a 401k loan often becomes due in full within 60 days, or it counts as a withdrawal with penalties. It's a band-aid on a bullet wound. It addresses the symptom debt without treating the disease. Spending saving habits. My take: I cannot stress this enough. Avoid this if at all possible. The long-term cost is catastrophic. Exhaust every other option first. The temporary relief is not worth sabotaging your 70-year-old self. 5. Bankruptcy. The legal fresh start. What it is: a legal proceeding where you declare you cannot repay your debts. The two main types for consumers are Chapter 7 liquidation and Chapter 13, a 3 to 5 year repayment plan. The human pros: the harassment stops immediately. The automatic stay is a court order that halts all collections, lawsuits, and garnishments. The phone stops ringing. You can breathe. A true reset for people buried under medical bills, job loss, or disaster. It can be the only way to ever have a financial future again. The human cons: the nuclear option. It remains on your credit report for 7 to 10 years, making it very hard to get loans, rent apartments, or sometimes even get certain jobs. Emotional toll: the process is long, stressful, expensive in legal fees, and can carry a feeling of shame, though it shouldn't. It's a legal tool for a reason. Not all debt is erased. Student loans, child support, and recent taxes usually remain. My take: bankruptcy is not a casual choice. It is a profound last resort for when there is genuinely no hope of repayment in a reasonable time frame. If you are considering it, you must consult with a reputable bankruptcy attorney. They can tell you if you qualify and which chapter is right for you. So, what should you do? 1. Face the numbers. Gather your statements. Write down every balance and interest rate, total it. This is your enemy, and now you know its size. 2. Pick a strategy based on your personality. Are you a disciplined sprinter? A balance transfer might be your race. Do you need order and a fixed plan? A debt consolidation loan could be your map. Please, think long and hard before using your home equity or retirement. If you are drowning with no lifeline, research bankruptcy with an attorney. 3. Change the behavior. No strategy works if you keep spending. Create a bare-bones budget. Find where your money is leaking. Use cash or a debit card. This is the non-negotiable part. 4. Seek help. Non-profit credit counseling agencies like the National Foundation for Credit Counseling can review your situation for free and help you set up a plan. Sometimes, even a debt management plan (DMP) with reduced interest rates. Getting out of debt is a journey of patience and consistency. There will be tough months. But every single payment you make above the minimum is a direct punch to the interest monster's face. You are taking back control. You didn't get into debt overnight, and you won't get out overnight. But you can start today. Pick one step, just one. Look at your smallest debt. Can you pay $20 more this month? Do it. That's how it begins. I believe you can do this. Now, go make a plan. Your future, debt-free self is already thanking you.